Hello and good morning, ladies and gentlemen. Welcome to today's Virtual Non-Deal Roadshow. My name is Noella Alexander Young, Virtual Event Moderator here at Renmark Financial Communications. On behalf of our team, we'd like to thank everyone in Chicago and surrounding areas for joining us today for the presentation of Ore Minerals trading on the NASDAQ under the ticker symbol AUGO. Presenting today is Kleber Cardoso, Chief Financial Officer. With that being said, I will now hand the floor over to Kleber.
Thanks, Noella. Thanks, everyone who's watching. Good morning. Kleber Cardoso, CFO of Ore Minerals, have been with the company now for over 7 years. And I'm going to take the next 20-25 minutes then to introduce our story. Aura is a gold and copper producer, focused on the Latin America region. And as Noella said, listed on NASDAQ. In snapshot, we are a growing company. The company has been growing significantly in the last few years. We more than doubled our production in gold equivalent ounces in the last 5 years. Now we have 6 mines in production, 1 project in construction, and 1 ready to build, and opportunities to expand the production capacity of the existing mines. So our business plan is to double again in the next few years. So we're a growth story in the middle of the growth curve. Besides being a growth story in terms of production, we have been also growing significantly our reserves and resources in the last couple of years. In this last year alone, we doubled the proven probable reserves. We have been increasing measured indicator resources, and also such as the increase in terms of production. I would say we're in the middle of the story of increasing our mineral resource base, because we have close to 600,000 hectares of mineral rights in the different properties, which roughly speaking, we know roughly 10 to 15% from a geological perspective. So there is still a lot to come when we talk about understanding the geology of our properties and increasing the reserves and resources that we have in our base. And besides being a growth story, I can say we are also a dividend story. We have been paying substantial dividends since 2021 when we put out a dividend policy. Our dividend policy states that the company pays at least 20% of its EBITDA minus recurring capex on quarterly basis. But since 2021, we have been paying above our policy in most cases. Our dividend yields in the last 12 months has been close to 5%, but has ranged, depending on the year, from 5% and up to 13%. So has been high and consistently high. So have been paying consistent, significant dividends as well. And we have been growing the company quickly in the last few years. We have planned to continue growing, and we're paying dividends without putting a pressure on our balance sheet. Our company is pretty much unlevered. Our net debt over EBITDA ratio is below 0.2 times. And I'm going to go over the next pages on how we have been able and what we plan to continue doing to keep growing the company, growing our production, revenues, results, paying more dividends, and while remaining our balance sheet remaining healthy. In terms of where we are, as I mentioned, you see here on the right side, we're a Latin America-based company, now 6 assets in production. In Brazil, we have 4 gold mines now producing. One of them, called Apoena, has been in production for a couple of years now, but we have 2 producing mines, which we built and put in production in the last 4 years. Were projects that at sometimes we acquired, junior mining companies, usually listed on either TSX or on the Australian Stock Exchange. Did a new feasibility study, looked to optimize the returns, and then build, and we build on time and budget and put in production. We did this with a project called Almas, in another project called Borborema. Both, as I said, were built in the last 4 years. The first one was just 16 months on time and budget. The next one was also a very short time to build the project was 22 months, also on time, on budget. And now we're going to the next projects with the same construction management team to build the next 2 projects that we have in our portfolio, which is going to continue growing the company. So besides then these 3 mines that I mentioned, since December, we have a new mine called MSG, which was part of the AngloGold Ashanti portfolio. We closed this acquisition in December, and it's a mine that we're going under turnaround phase, but it's already giving us return, adding to our production and to our cash flows. So these 4 operating gold mines in Brazil. Outside Brazil, we have in Honduras an open pit heap leach gold mine called Minosa. And in Mexico, we have another mine. It's Aranzazu is the only mine in production where the main product is copper, not gold. So the 6 mines together, they produced in the last 12 months about 300,000 ounces of gold equivalents, of which about 85% was gold. Our revenues came from gold and close to 15% from copper. Most of our production coming from Brazil, a little bit more than 50%, but Mexico and Honduras being also an important part of our portfolio. And for this year, we are already expecting some substantial growth. So if we see our guidance for this year is to produce between 340 to 390,000 ounces, which is already a substantial increase compared to what we produced in the last 12 months, basically because MSG is the mine that we acquired in December. It's going to bring additional production for the whole year. In one of the projects that we built, this project called Borborema, we produced for 3 months last year, and now we're going to produce for the entire year. Then going forward, how we can continue growing besides this 340 and 390,000 ounces. So we have a target to exceed 600,000 ounces of gold equivalent in the next few years by building 2 new projects. One of them is under construction in Guatemala. It's called Era Dorada. We announced start of construction earlier this year, should hit production by the beginning of 2028. It's going to add with another roughly 110,000 ounces per year. And next would come another gold mine project in Brazil called Matupá, which is going to add for another 55,000 ounces in the years to come. And expansion in production capacities in some of the mines that I'm going to go in the next few pages in more detail. When we look to our past and how the company is performing, here is in more detail our growth in production, revenues, cash flows. So you see that our production increased by 150% since 2018, has been increasing steadily over the last few years, basically because of this strategy. Acquiring new mine, building, putting production, and then expanding the production capacity. And for this year, there will be already, as we see, a substantial increase expected. When you see the all-in sustaining cash costs, our all-in sustaining cash costs until 2025 were pretty much solid second quartile player in the mining industry. We see some expecting increase by 2026. This is mainly because of the MSG mine that we acquired from is a mine from the AngloGold Ashanti portfolio. Is a mine that has been operating with a high cost, has all-in sustaining cash cost now above $3,000 per ounce. That's basically because there is underperforming in the primary development of the mine. So there is a big idle capacity at the mine and the plant. So our strategy is to work to address those bottlenecks during the year 2026. And then from 2027, we expect to see substantial improvements in performance. Our target for that mine specifically is to bring it below $2,000 the all-in sustaining cash cost for that mine. But excluding then this specific mine that is in turnaround phase, we're still a solid second quartile player. Then when we look into the results of increasing production and competitive costs, we see not only revenues increasing substantially because of both the production and, of course, metal prices, but also our EBITDA accelerating. We closed Q1 with over $710 million in EBITDA, about 60% EBITDA margin, of which close to 50% has been our cash conversion. Of this EBITDA, we're converting a significant portion in cash flows, which has allowed us then to make acquisitions, pay dividends, and grow the company and return capital to the shareholders without putting our balance sheet in stress. Looking a little bit more in detail to our cash costs, when we compare especially the last year performance, as I mentioned, this is a chart. This is a chart that we acquired from a company called Metafocus, which consolidates over 400 gold mines into a database. We see we closed pretty solid in the second quartile in terms of all-in sustaining cash costs. With the new mine MSG, it's pulling to a higher cost in 2027. But in the meantime, we are working two fronts. One, in the turnaround to reduce the all-in sustaining cash cost for MSG. And at the same time, the new projects that are coming online, they are first quartile. So Borborema just came in commercial production, has an all-in sustaining cash cost in around $1,200 per ounce. Era Dorada and Matupá, which is going to be the next two projects that we're going to build to grow the company. They are also in the first quartile. So over time, we expect to see Aura pretty much solid where we are now in the second quartile, but producing roughly double our production that we have today. We compare, for example, last year performance with some much larger gold mines. You see we have been more competitive despite being a smaller company than, for example, Newmont and Barrick, which are the two largest companies in our sector. So we have been quite competitive. We have been putting money to increase the expansion of the company, invested over $600 million in the last few years, as I mentioned, through M&A, construction of new projects, and investment in exploration to increase our reserves and resources. When you see the mineral resources and mineral reserves base has been increasing substantially, if you see 25 compared to the previous year, there was a significant increase. At the same time, paying substantial dividends. And at the same time, as I mentioned, pretty much on leverage, our net debt over EBITDA never exceeded 1 time. And now it's close to 0. Looking ahead, how we expect to continue generating shareholder value, it's basically continuing doing the same strategy. So the growth in production, which I mentioned, continue increasing in reserves and resources. Also, as I mentioned, there is good opportunity considering all the area that we have and considering that there is still a lot to know more geologically speaking. And as we grow, we expect to see additional improvements in our multiple, our PNAV. When we see compared to peers and larger companies, we see that larger companies that have a higher production, they trade at a higher multiple. So we have a vision to become 1 million ounces gold producer in the medium term. That's going to come by both bringing these new mines in production, delivering that on time and budget, as we did in the last few projects, and from new acquisitions. Once we get closer to that target, we expect to also our valuation multiple to get closer to the new peer group that we're going to be moving towards. Looking more detail, our growth plan in terms of data, we released to the market this ambitious plan to more than double our production in the coming years. So you see in 24, we already growing. Now in 24, we produced 267,000 ounces. So our plan was to Borborema, one of the mines in Brazil, was under construction by that time. So it's going to add from this year 76,000 ounces. MSG, once the turnaround is completed, and now from 27, we expect to see annual production of 80,000 ounces. Era Dorada, now in construction, is the new mine in construction. It's going to add 111,000 ounces. Matupá, the next one in line, and then we have internal expansions in some of our properties, so we will be exceeding 600,000 ounces, not including some assets that we have in our portfolio that was in the map. When I showed the map, there were other some assets that I didn't mention because they're in an earlier stage. They're still in exploration stage. So we have Carajás, for example, is a copper project in the Carajás district in Brazil, which we expect to invest in exploration for maybe 2-3 years before having reserves and resources and a growth plan. So this is an upside. This Pezão and Pé Quente, they are also opportunities that we have in one of our projects, Matupá. That project might become bigger, depends on the results. But considering just which is pretty much advanced, it's either in construction or in production, or we have like full feasibility study, we have a pretty much solid plan to get to the 600,000 in the next few years. So it's just a matter of executing. It's much more execution risky than knowing where the growth is going to come from. Touching a little bit on this risk of execution, we like to show some cases, what we have done that shows this risk, of course, always exists, but we believe it's pretty much manageable considering our track records. Recently, we built 2 projects, Almas project and Borborema project in Brazil. Almas, we built in 22 and 23, declared production by the end of 2023. Again, was built on time and budgets. Was a project that we decided to decrease its size when we made the construction decision. And this is pretty much our mindset. It was a project initially when we acquired with a design to produce over 3 million tons per year, to process over 3 million tons per year at the plants. We decided to reduce the size of the project, so we decreased the size, so the project started processing 1.3 million tons at the plant. And why we did that? Mostly to reduce execution risk and reduce the upfront capex and maximize expected returns. So you see the expansion, the construction capex was very small for this type of project, was just $76 million. It allows us, the payback, expected paybacks was about 2 years at the time when I announced the project, with a very high expected internal rate of return, close to 50% internal rate of return. So making it small, reduce the capex, reduce complexity, we could build quickly. We built, as I mentioned, 16 months, put in production. And now, since then, we started generating cash flows and are investing the cash flows that we are generating to expand the production capacity. So now we're going to the original 3 million tons now in 2026. That was originally designed, but without taking all the risk and all the time up front. So this is pretty much our mindset. Let's decrease the risk, let's decrease the front capex, build quickly, reduce complexity, put in production, generate cash flows, and then look for the upsides. That reduce risks, reduce paybacks, and also is one of the reasons we have been able to grow quickly without stressing our balance sheets. The same is with Borborema. Borborema, we built it between 24 and 25, also on time, on budget. Borborema is bigger than Almas. So the construction capex was $196 million, also built on time, on budget. When we build it to produce 2 million tons, process 2 million tons per year, had 11 years life of mine. We have been investing in the meantime to unlock the geological potential of this mine. And now this year we have been able to substantially increase the reserves and resources. Now we have we increased it from 11 years life of mine when we started building this project. Now we have 36 years life of mine. And now we are going the same stage that we did for Almas. We're looking for the potential to increase the production capacity here. And the next one is Era Dorada. Era Dorada, this is under construction. We are using the same construction management team that built Almas and built Borborema. Now they are in Guatemala, building Era Dorada. You see the returns, our projects, they are not the biggest in the sectors, but probably among the best in terms of returns. If you take the relationship between the NPV and the CapEx, so for Almas, 15 times, Borborema 9 times, Era Dorada 4 times. Era Dorada, for example, internal rate of return is 36%, considering a very conservative gold price is about $3,200. So the actual return is, we expect to see even higher than this. Increasing reserves and resources, I touched a little bit on this. So we have been accelerating the money we're allocating in geological exploratory activities. We have a very low discovery cost. Our discovery cost for new ounces has been $34. If you look at international benchmarks, has ranged from $130 to $200. One of the reasons is, as I mentioned, we have still a lot to understand. So there is a lot of low-hanging fruits. So we have a lot of areas still to study, to increase the reserves. You see here on this chart on the bottom, here in green, our proven and probable reserves more than doubled in the last few years. Inferred has increased as well. The only reason measuring indicator has decreased is because we converted a lot into reserves, but it's also working this strategy to increase the reserves and resources. We have a high quality of portfolio of not large mines, but profitable mines with competitive costs or projects with high returns, low unleveraged balance sheets, so we can continue growing, accelerate expansion, and be open to potential creative M&As. We have a very strong culture focused on the results, big exploration pipeline and potential, robust growth outlook, expecting more than double our production in the next few years just by producing developing projects that we have in-house. Several certificates and recognition in terms of being a responsible company, paying robust dividends, and in terms of capital structure, now the market cap, it's close to $6.7 billion. Close to $300 million in cash, shareholding structure with some important names like Capital World, BlackRock, Fidelity, and others. Well, I think with this, we can end the presentation open to questions.
Thank you very much, Kleber, for the presentation. We'll now begin the Q&A. Your first question is, exploration spending has ramped significantly over the past few years. What measurable reserve conversion targets should be expected to justify continued elevated exploration budgets?
As you saw in one of the pages that I showed, our exploration spending has been very successful. We have been spending close to $25 per ounce that we convert. We're just not spending more because of limits in terms of team, in terms of the plan that we do, because otherwise we would be spending even more. So I think as long as we have this conversion rate, so we're spending so little it is much cheaper than going and buying any asset outside, $25 per ounce. So as long as we have the conversion rates that we're seeing, with the costs that we're seeing, we are going to accelerate and spend as much as possible because it's worth it.
You have several assets on care and maintenance. When might these be put back into operation? And if you don't do that, will you consider selling one or more of them?
We have just one mine in care and maintenance, which is in Colombia right now. The other mines, they are not in care and maintenance, that are not producing, are not in care and maintenance. So the ones that are not producing, Era Dorada in Guatemala is in the construction. Imatupá is ready to build. We don't like to build two projects at the same time, at the same stage. So we're never going to start building two projects at the same time. So Matupá, we're still discussing when is the construction decision, but that is ready to build. Probably when we're more advanced in the construction of Era Dorada, we plan to announce also potentially the construction of Matupá. Carajás is an exploration project that we are doing exploration, as I mentioned. It might take 2 or 3 years. It's still early stage. So I'd say just one in Colombia. That is because we have like so many things going on in our portfolio. Would probably come next. So I'd say just Colombia's in care and maintenance.
How long and at what cost will it take to relocate the federal road at Borborema?
So we have about, if I'm not wrong, 2 years to do the relocation. I cannot say because it's not public information, I never announced the cost, but it's not substantial. It's a 5.5 kilometer roads. It's not a difficult terrain, so it's not material, the capex.
Judging from the stock's reaction from Q1 earnings release, Wall Street apparently did not like the higher operating costs in Q1. Were those higher costs consistent with your expectations for the full year?
Yes, so that high cost is mainly 80%. In the earnings call, we show an analysis is roughly 80% explained by the new mine. We say it's good news. Actually, why is good news? It's in terms of returns, and again, we look a lot in terms of financial returns. It's a mine that we paid $72 million for this acquisition, and we knew the cost was high and would require turnaround, which we're planning for 2026. So 2026, the cost, answering the question, yes, 2026, the cost for that mine is going to remain high, above $3,000. Probably towards the end of the year, we should already see some results of the turnarounds, but that will be probably from 2027. Given that, so we didn't see any return from the turnaround yet, but the EBITDA generated in the first 4 months only for that mine was $27 million for an acquisition that we paid 72. So you can see the type of return that we can expect. So if you look to the returns, it's been a great results. Of course, when you take our blended all-in sustaining cash cost, that pushes up, which makes every sense because it's a turnaround phase. But I would say it's pretty much consistent with our guidance. So we released a guidance to the markets at the beginning of the year. Our cost during Q1 was within our guidance for the year. So in terms of planning, it's pretty much consistent to what we're planning.
How sensitive are your earnings to gold and copper prices?
Especially with gold, very sensitive. It's what I can say is very sensitive. I think anyone can track when gold price go up and down, which happen not only with us, with our peers.
Should we expect production of around 80,000 ounces in the coming quarter of 2026?
No, from 2027. We're not going to see. In Q2 should be pretty much similar or even a little bit more challenging than Q1 because what this is assuming that is for MSCG, the 80,000 ounces. But for MSCG, which is the mine that is in turnaround, is going a little bit more in detail that I believe is important. So what we found out is there is a bottleneck at the plant. So this mine has been running with idle capacity of close to 40% of the plant. Basically, it's an underground mine. There is historical underperforming in the primary development of the mine. So that has many reasons and has brought many consequences in terms of mining methods. We see there is a high cost for maintenance of equipment, and at the same time, low availability of equipment, underground mine equipment. So what we're going to do is we want to take pressure off from production for this year, focus on having good equipment with good maintenance, doing proper primary development, create a buffer, because today doesn't exist a buffer, so that in 2027, in the next few years, we're going to have a healthy operation. We are shifting from the modes that is our hypothesis we saw in the past, that was, okay, production at all costs on quarterly basis. We are addressing the structural problems this year, again, to have like a returns from 2027 onwards. So in 2026, we should not see this running rate in terms of production for this mine specifically.
Ore's production guidance jumps materially in 2026, but AISC is also expected to rise sharply. At what point does growth risk become less value accretive if costs continue climbing alongside production?
Yeah, again, the costs, as I mentioned, roughly majority of the cost is because of the new mine. Then the question would be, okay, does it make sense to add a new mine with high costs and then increase the blended average all-in sustaining cash costs? Because if we compare apples to apples, no, okay, I'm going to compare 2024 costs, considering the operations we had in 2025 costs with the operations we had in 25, and comparing 26 apples to apples. You're going to see there is some increase, but it's not material increase. So the material increases comes from the new mine. So that question would be rephrasing that question. Okay, is it worth to add this additional production with these high costs? And then my answer is, in this case, yes, because if we look to the cost, is high, but if we look to the return of the invested capital, makes a lot of sense. We paid $72 million for EBITDA of $27 million in just 4 months, which means roughly we would get 1 year payback for this investment without improving anything. So we have all the upside of the improvement. So if you have other opportunities like this, again, we look in terms of returns. So what's the payback? What's the impact in our cash flows? In this specific case, it made a lot of sense.
What is your hedging strategy? What gold hedges are remaining, and what are the terms?
Yes, so historically we had done enter into gold hedging to fund material investments. So the 2 projects that we built in Brazil, Almas and then Matupá, we raised financing with third-party credit providers. And it was substantial at the time for the company. So if you take the last one, Borborema was a $190 million investment. We've expected 3-year payback, considering at the time feasibility study gold prices. So our rationale was, okay, let's make sure that we are going to get at minimum the gold price that is required to pay back the investment. So at the time we did a zero cost collar. So we bought put options at the feasibility study gold prices, and we sold call options for 3 years with this rationale. We're investing $100 million. We have equity and third-party capital, so we need to make sure no matter what happens with gold prices, we're going to get the payback and pay everyone. So right now, fortunately, overall, unfortunately for this specific case, but as like the company as a whole, fortunately, gold prices since then moved substantially. And right now, what we have is about 180,000 ounces of gold collars outstanding, which expires between today and 2028 with a ceiling price of $2,400. Which means that for this portion, we're hedged this ceiling price for $2,400. This is roughly, depending on the quarter, roughly 20% now, and project can go down to 50% of our global production. So if you take ore as a whole, Now, roughly 20% of our production is kept at 2400, and then over time, we're going to clean these positions until 2028.
Do you see yourself as more of an acquirer or a seller of assets?
Acquire, considering where we want to be, our target to be a 1 million ounces gold producer. At the moment, definitely much more an acquirer.
Where do you see cash costs at MSG leveling out at once production is ramped and cost reduction initiatives have been executed?
Yeah, our target is to push all-in sustaining cash costs below $2,000 per ounce. All-in, not only cash costs, all-in sustaining cash costs from 2027. So it's not going to be, like I said, in 2026, but we want to lay the foundations in 26 to in 2027 onwards start seeing this much lower all-in sustaining cash costs.
Borborema's road relocation could materially increase reserves and mine life. What remaining regulatory or execution risks still exist?
From a regulation perspective, there is nothing. We need to relocate the roads. We just need to build a new road, So it's pretty much limited what we see the risk now.
Are there any plans to add development or exploration stage assets to your portfolio?
We could. So as we're looking for potential acquisitions, in terms of prioritization, we would prioritize probably something in production, because we have other mines to build and put in production, and so we have some assets also in terms of exploration stage. But it all depends on writing the right opportunity at the right price. So we are open for potential acquisitions if they make sense in the different stages, either in production, ready to build, or exploration. So to answer the question, yes.
Once the Borborema collars expire, should investors expect Aura to remain largely unhedged?
So it depends, because it all depends on which investments we're going to make. So going forward, just as in the past, we're not going to hedge on an ongoing basis, just because we believe that gold prices is a good level and we want to take advantage. So we're not going to do that. At the same time, we will have to be conscious if we do, for example, a major acquisition, and if it thinks we don't expect, we expect gold prices to remain at favorable level for many reasons, in the years to come, but we cannot guarantee, of course, which level is gonna be. So it depends on the size of investments and how much risk we would put to the company until we get the payback for that investment. So it's pretty much the same mindset we had in the past. One opportunity that we have here that didn't exist when we did the hedges before is on just hedging against the downside, because gold prices, again, have moved in the last few years. We might have opportunity if we have the need to buy, for example, put options instead. Then it's buying insurance, where we limit a minimum gold price to get a return without selling a call or without fixing future prices. So it would be buying insurance and protecting against the downside, but not giving away a potential upside. Or depending on the case, limiting, like Borborema, we had 80% of the production, Almas was similar, 80 to 90%. Maybe in the future, we don't need to limit anything in terms of production for the upside, or we can limit a much lower level.
Excellent. Well, thank you so much, Clever, for all of your insight today. And thank you to everyone who submitted questions. If you not get a chance to submit your question, you can reach out to the appropriate account manager here at Renmark. That concludes our presentation for today. But before we go, I will turn back the floor to Clever for final remarks.
Yeah, thanks, Noella, for the opportunity. Thanks for everyone attending. Again, as a summary, it's Aura is a growing company that we have at the same time growth ahead of us, both in terms of production and also in terms of increasing of reserves and resources with a track record. So we have shown that we know how to acquire companies, how to build projects, how to turn around the challenging cases. Also, we know we have a competent team that has been able to convert increasing our reserves and resources. So a company that provides still good opportunities in terms of growth, but with a track record, and in the meantime, paying substantial dividends. Have been paying dividends not only substantial recently, but on an ongoing basis for the last 5 years. So going forward, we expect pretty much to keep delivering this same strategy, growing, not leveraging our balance sheet, and paying dividends and generating shareholder return.
Thank you, Kleber. And once again, this was Aura Minerals, trading on the NASDAQ under the ticker symbol AUGO. Thank you to everyone in Chicago and surrounding areas for joining us today. Please stay tuned for other presentations in your area, and see you next time.